Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hope everybody had a very good day of trading. And in today's markets, guys, well, the consolidation to the downside simply continues. However, today, there was not much rotation to be had. Most of every sector in the S&P 500 was actually red, and a lot of sectors that have run since last Thursday's CPI report, namely value names and the risk-on trades such as the Russell, also took some time to take a little bit of a breather after a substantial last 5 to 6 trading days worth of rally. So in today's video, guys, we are going to take a look at a few key metrics. Number one, we're going to take a look at a few earnings reports that I have prepared for you guys. We are going to do TSMC, which reported to this morning before the open, Domino's Pizza, same thing before the open, and the big one, of course, Netflix. Now, there was another interesting one today in the name of D.R. Horton, one of the leading home builders in the United States. We're going to do those tomorrow with American Express, guys, just because I don't want to do too many earnings in one single day. So we're definitely going to take a very close look at home builders tomorrow and see whether there's still more juice left in that trade, even despite their substantial rallies over the past 2 weeks. So after we take a look at our earnings, guys, we're going to go through our major technical analysis rundown of our major market indexes. Thereafter, take a look at our big tech names and see, are they potentially approaching some buy the dip opportunity levels soon? And lastly, guys, take a look at a few swing trades that I'm very closely eyeing to potentially position myself in the next coming days of trading. So without further ado, guys, let's get right into it. SPY down about 0.77%. QQQ not down as much as yesterday, thank goodness, only down about 0.47%. But for the most part, guys, very big day of red across the markets. No real rotation to be had. Yes, NVIDIA and Broadcom coming back nicely with a few other semiconductor names. Meta, a little bright spot in the green up here. But for the most part, guys, very broad-based market consolidation as a whole. A lot of indexes, or a lot of industries rather, that have ran a lot. Think of industrials, real estate, energy, healthcare, financials. Those have all run a ton in the last 5-6 days. So nice to see them take a little bit of a well-deserved breather. Now, moving on to the one-day relative, guys, you will see the only sector with some positivity today was energy, but everything else really moving to the red, to the downside. Healthcare being led to the downside by Eli Lilly, one of their rare 6-7% days worth of declines. So that being said, guys, let's jump right into our earnings before doing more technical analysis on the SPY, and we're going to do these in order. So we're going to take a look at Domino's Pizza to start everything off. Domino's Pizza, one of their worst days here, guys, in the last 5-6 years of trading. You would have to go back pretty much to COVID to find a day where you were back more than 13.5% on a single day of trading after their earnings. Now, their earnings, as a matter of fact, guys, I went through them and they were very, very decent. A little bit of an overreaction by Wall Street, in my opinion, and we're going to get into the reasons why. But just understand, guys, they had a very nice beat on EPS here by about 10% and a very decent revenue number as well. Even though they came in only $5 million below the estimate, still a very decent quarter for them. So what exactly happened, guys? Why is Domino's down 13.5% on the day after having a very nice start to the year as a whole? Well, guys, it all lies in their international expansion. There was one slight little issue with international expansion in terms of net new store openings, but the CEO actually commented on this and doesn't see a problem. So let's get into it. Domino's Pizza CEO doesn't want to whiplash diners with promotions. Let's take a look at this. So the stock slumped 13% on Thursday as investors worried about headwinds and international expansion. The CEO thinks the risk might be overblown. So let's get into it, guys. Obviously, we know consumer discretionary spending is down. People are spending less money on food away from home, right? We've seen that from reports from Starbucks, McDonald's, and different companies alike. So now Domino's Pizza, are they going to say things are slowing down? Well, actually, as a matter of fact, they're not for them. So Domino's Pizza said it hasn't increased the frequency of promotions despite the ongoing value war amongst peers. Think of Burger King, McDonald's, Wendy's, all in a very big pricing war right now. A lot of promotions to try and reattract those customers. Domino's is not doing the same thing. In the second quarter, the world's largest pizza chain continues to grow sales even as the restaurant industry overall experiences a slowdown. So really going against the trend here is Domino's Pizza. What continues to make us special on value is that consumers don't get whiplash, said the CEO. Our discounts go across our entire menu. It's not just, hey, it's expensive, and here's one little thing that you really may not want. Very interesting. Pricing marketing strategy by the company, right? So the company increased pricing by 1.5% in the second quarter, still having pricing power. Much of its revenue growth was driven by increasing order volumes in both its delivery and carryout business across all income cohorts, according to the CEO. This is good, guys. Total revenue came in at $1.1 billion, an increase of 7.1% from a year ago. Very decent. Although it's slightly below the analyst expectations, the growth is stronger than what Wall Street expects for many other fast food chains this summer. So Domino's Pizza, one of your top performing fast food chains in the market right now. For the second straight quarter, we drove US comparable performance in the healthiest way possible through profitable order count growth. Everything's working really, really well here, guys. Same-store restaurant sales increased 4.8% at U.S. stores and 2.1% at international locations. For the U.S., guys, for any quick service restaurants, you want to see same-store sales above the 4% mark. That's really the industry standard, which shows whether or not it's expanding or contracting. So for Domino's to be at 4.8, that's very, very decent. Earnings grew 31% from a year ago. That's also very good. Last year, Domino's announced a 5-year growth plan dubbed Hungry for More that includes 1,100 new store openings through 2028 and an annual boost to sales by 7%. This, guys, is where the share price decline came from today. They actually had to cancel that guidance, and we're going to get into why. In the second quarter, Domino's opened 228 new stores, mostly in international markets, and shut down 53 locations. Let's pay attention here. Our year-to-date performance demonstrates that our Hungry for More strategy is off to a great start, having an immediate impact on sales and profits, said the CEO. While the company had planned to open over 925 net stores, the number of openings minus closures in international markets this year, management said the number could fall short by 175 to 275 due to challenges faced by one of its major franchisees in the Japanese and French markets. Here is why. Investors might be overreacting to isolated risks in those markets, said the CEO, noting that the Domino's Chinese and Indian franchisees has increased their forecasts. There's a lot going well in international from a growth perspective, so only the Japanese and French markets having a little bit of slowdown. The stores being closed, including those in Japan and France, had very low volume, said the CFO. They'll therefore have a very small drag on the company's top and bottom lines. When you actually put it all together, the aggregate implied impact to operating income is really immaterial in the grand scheme of things, talking about those that weakness, right, in France and Japanese markets. Fast food chains such as McDonald's, QSR, Burger King, and Wendy's have entered a value war this summer, rolling out deals with aggressive price cuts to lure consumers back to stores, a move that will weigh on profit margins, but not for Domino's. That is the key takeaway, guys. So the one reason for this entire drop right here that I truly do believe is overdone is a slowdown in their international expansion. One of their franchisees not opening as many stores as they planned in France and Japan, and as a matter of fact, closing some of those stores down. Here's your international and same-store sales metrics. You can see that they're expanding very nicely off of the bottoms in 2022. So the US obviously is in red and international is in blue. The trend is definitely moving in the right direction. Domino's total global stores, they continue their expansion here, guys. So even though they're not opening as many stores as they wanted to, that 1,100 number, it'll still be high 800s to 900 stores, which is very, very healthy for company expansion. Now, here is this one line right down here is the reason that the share price was down over 10% today. The company is temporarily suspending its guidance metric of 1,100 plus global net stores until the full effect of DPE, Domino's Pizza Enterprises store opens and closures on an international net store growth are known. So that is why, guys, right, they're expecting to cut back between 175 to 275 stores because of those challenges in just a few international markets, guys. But we know Domino's Pizza is one of the franchises in the world that operates amongst the most amount of countries. So a slowdown in 2 of their smaller markets, as said by the CFO, is not going to have a material impact on the company whatsoever. Now, let's take a look here, guys, at their valuation and see whether or not this may represent a decent buying opportunity. And I really do think so here, guys. With revenue growth of 6.6% per year, EPS growth of 11% per year, that gives them a forward PE ratio 2024 of about 25.6. Now, 25.6 in the grand scheme of Domino's history, guys, is really right in line, right? The forward PE usually always hovering between 25 to 35 at its most expensive here, really in line with historical averages. So the company at this point in time, not undervalued, but not overvalued as well. I would say that pretty much it is around fair value right now. Forward PEG ratio at 410 is about a 2.32, guys, but the company obviously isn't growing as fast as other tech companies or stuff like that, right? So the PEG ratio, a little bit overvalued right here. However, when we take a look at the company's historical PE average ratio, it does appear that Wall Street, at least for the last, let's call it about 10 years, is agreeing to give them that type of PEG ratio. So take that with a grain of salt, right? PE is in line with the historical average. Now, in terms of the company's fundamentals, guys, I mean, the company's doing great. They're they're expanding nicely. You can see all analyst price targets are well above the current price right now, and EPS, gorgeous EPS expansion over the next couple of years, and gorgeous revenue expansion as well. I truly see absolutely nothing wrong with the company other than potentially mild concerns of a consumer slowdown. But from what the company just told us, the CEO and the CEO, they are saying that they will not be impacted by a consumer slowdown. As a matter of fact, they actually saw renewed interest in the brand from all income cohorts. Those are their words, not mine. So Domino's Pizza right now, a little bit oversold on the daily, as you can see down here on the RSI. And Domino's Pizza really doesn't get oversold that much. And usually when it does get oversold, it can trickle down a little bit more, but eventually they do have very, very nice bounces, especially in the average bull market, right? Whenever we get down to RSIs as low as this 23, that was the low right here. Nice little rally. This low right here as well. Nice little rally. So it could just be an opportune moment to be picking up some Domino's. Now, keep in mind, I had one support labeled here for the earnings, but there's actually a very larger one coming up soon, right? That we're coming up into right now, which is pretty much your 405, right where we are, all the way down to about 390. I would not be opposed to starting a little bit of a position on Domino's Pizza right there, just because we are, even though the bears have taken back a lot with this move, guys, still at a very nice monthly uptrend. The fundamentals of the company are good, and company guidance from the management team is also good. So I really don't see any red flags. May just be a case in point of an overreaction from Wall Street. It happens more frequently, than we can possibly imagine, right? So very, very nice potential opportunity for Domino's Pizza. But if I do start a position, guys, it will be small because it is a counter trend trade, right? Consumer discretionary names right now are not very much in favor. So we're trying to counter trend trade this one. But if it's a long-term investment, guys, this business over the next 5 to 10 years, I think, in my opinion, is a no-brainer. And the market cap is relatively still small, guys. Only pretty much only a $14, $15 billion company, and they generate about almost $5 billion in sales per year. So that's everything for Domino's Pizza. Now let's get into another interesting one, guys, and this is going to be TSMC, obviously the chip manufacturing leading company in the entire world with over 62% of the entire market share for manufacturing semiconductors. Extremely large company. Now, a little bit of the question here, guys, was after pretty much 9 months of rally in a row, only green, could TSMC hold up the growth? And what is going to be their guidance? Is the guidance for demand still very, very strong? And as a matter of fact, guys, they absolutely crushed it. Demand is still very, very, very strong. So moving into their earnings, guys, this was a big concern, especially after ASML's earnings yesterday, which led all the sector to come down, right? Double beat by TSM, 4% beat on EPS, and a very nice 1.6% beat on revenue. Let's take a quick look at what the article had to say. TSMC's second quarter profit beats expectations as AI chip boom continues. Very, very interesting piece that we're going to look into right here. So TSMC reported net revenue rose 40% from a year ago, while net income, their profit margins, or their bottom line profits, increased 36% from a year ago, guys. Substantial increase in both revenue and profits. Now, here's what the CEO had to say. Said on a call on Thursday that business in the second quarter was supported by strong demand for its industry-leading 3nm and 5nm technologies, though it was offset by continuous smartphone seasonality. We'll get into that in a little bit, right? The smartphone market, very big market for them. Now, I also try to reach the supply and demand balance. Here's what he had to say, guys. I also try to reach the supply and demand balance, but I cannot. Today, the demand is so high, I had to work very hard to meet customer demand, said the CEO. The supply continues to be pretty tight all the way through 2025, Wei warned, adding that the firm hopes the tight supply can ease in 2026. He just gave us guidance for the next year and a half, guys, and said that they cannot keep up with all of the demand. Absolutely phenomenal in terms of those statements. The chip giant currently produces 3nm chips and plans to commence mass production of 2nm chips in 2025. Typically, a smaller nanometer size yields more powerful and efficient chips. For the third quarter, the business is expected to be supported by strong smartphone and AI-related demand, said Wei, adding that they continue to expect 2024 to be a strong growth year for TSMC. That is all you guys have to know pretty much, right? The CEO's comments say it themselves. TSMC held 62% of global foundry market share in the first quarter, up from 59% in the same period year ago. So definitely, guys, one of your industry leaders, right? One of the most important companies in the entire semiconductor industry, in my humble opinion right now. Now let's take a look at some of their projections, right? So 2022, 2Q 2024, revenue by technology, right? So here's your 5nm chips. A lot of them are being used for data center applications, smartphones, stuff like that. But they are starting to build out their 3nm chips, which is that red little bubble bubble right here. And you can see that all lines of business, as they pivot away from the slower 7 nanometers to the 5s and the 3s, you will see a product mix shift. So nice to see that everything is moving in the right direction across all of their competing technology. Now, revenue by platform, guys, very, very good. Here is HPC. That is your data center applications, right? For pretty much your graphics cards and stuff like that. So still one of your leading metrics for the company, leading line of business. Smartphones for them represents 33% here, guys. But take a look at this growth rate by platform quarter over quarter. Smartphones are still in a little bit of a lull. Every single other line of business is doing very good, but a line of business that represents 33% of all the revenue is down or flat, right? So we can't forget that. They are now saying that in the second half of 2024, demand for smartphone chips is going to start curling up and get back to normal. We've had that same guidance, guys, from other companies alike. Micron has been hinting at that as well, to where second half, 2 industries are going to come back. Smartphones and more specifically automotive should have very good second halves of 2024. So all in all, guys, tremendous quarter for TSMC. Nothing bad to say about the company. Fundamentals of the company are absolutely amazing, guys. Take a look at this EPS growth. Very, very stable EPS growth. Very, very stable revenue growth as well. The company doesn't really have that much debt either and generates a tremendous amount of free cash flow with the profit margins that they have. They make pretty much, 36, 38% net profit margins for a company that supplies an actual physical product. To be close to 40% margins is absolutely crazy, guys. Usually you only have those margins when you're a tech company selling software as a service, right? So take a look at this, guys. Way more cash than they have debt currently, and generous amounts of free cash flow being generated every single year. So everything looking extremely strong for TSMC, guys. Nothing bad to say whatsoever. As a matter of fact, right, we can see down here, did I label it? I don't think I labeled it really quick, but I just wanted to show you guys their total net margins, but I don't think they're there. But anyways, guys, just take my word for it. It's about 36.8% for the quarter. Extremely, extremely, extremely strong quarter for them. Very, very nice. In terms of their valuation here, guys, well, valuation is pretty decent, to be honest with you, right? So revenue growth, 16.5% per year for the next 3 years. Even EPS growth for the next 3 years, almost 20%. Double-digit growth everywhere that it counts. Very, very nice. Now, their forward P at $170, where they are right now, about a 27. At a first glance, appears a little bit high, but when we divide this by their EPS growth rate, we get a PEG ratio of 1.38. That is really, really cheap, guys. Extremely decent valuation for a company that has ran still so substantially in the last 9 months of trading. I would not be surprised if they do continue. Now, the one thing here, guys, is that they may get dragged down by overall semiconductor consolidation. So in the event that that continues happening, guys, if we just continue consolidating, you can see here that we did lose the weekly uptrend right here. In the event we continue consolidation into maybe the end stages of July and maybe into the early months of August as well, that will not be because TSMC is doing poorly, just maybe an overall industry, little bit of a pullback on a lot of names that have run a lot, right? TSMC, I would not be opposed to even taking a small position here, especially if you're a more long-term investor, 5 to 10 years out. But if we're looking to maybe pinpoint swing trade and entry, then guys, I have to be a little bit more patient. If it comes down 160 all the way down to about 150, that would be a very decent first entry for the stock. And obviously, I'm not sure if it's going to get back here, guys, because it's now a long way away, but this is my ideal entry for this company, 145 down to about 125. As I said, not too sure if it ever does come back there, but it would be a very hell of a nice breakout retest of the prior all-time highs and maybe continue running on further into 2025. As the CEO said, it was going to be a fantastic year for them. So that's pretty much everything for TSMC. Amazing company, no red flags whatsoever. Now, the third company that we're going to take a look at, guys, is a big one as well, and that's going to be Netflix. So Netflix down after their earnings, only about pretty much 0.12%, almost nothing. They were down initially about 6% and then pretty much put in some gains and now flattening out exactly almost where they closed the day. So Netflix, guys, everybody was expecting this one to come in a little bit bearish, right? Just because of the overall timidness in big tech right now. We know we've been in a massive big tech consolidation now for pretty much the last 1 week of trading, right? Most of your major losses have come from big tech, and that led everybody to be a little bit nervous coming into these earnings, as any miss from Netflix resulting in a 7, 8, 9, 10% decline to the downside would most likely be felt in the rest of big tech as early as tomorrow. But that didn't happen, guys. Netflix reported a very solid quarter, and to be honest with you, I am not surprised in the slightest. So let's take a look here. Double beat, guys. Beat on EPS, 3% beat, and a nice little beat on revenue as well, coming in above the expectations. So let's take a quick look at some of the highlights from Netflix. So Netflix right here. So Netflix guided to third quarter revenue of 9.73 billion, a miss compared to the consensus estimates of 9.83. That is their further guidance for next quarter. The only reason that the stock came slightly down in the after hours, that's why I highlighted, the only bad thing about this entire report is the third quarter guidance. The company did increase its full year 2024 revenue growth projections to 14 to 15%, up from the prior range of 13 to 15. So even though they said Q3, which is next quarter, will come in a little bit light, they did say Q4 is going to be strong, and they reiterated their 2024 full year revenue. That's why I do think that initially we had a bad reaction, but quickly we're able to really recapture all of that back, looking very, very strong for Netflix. It also expects full year operating margins to hit 26%, an increase from the previous 25%. Netflix's operating margins, guys, have always been very, very strong, right? Let's take a look at this right now. So I think I have something highlighted for you guys. Netflix operating margin expansion, right? So take a look at this operating margin expansion, which is your red line right here. And you can see they went from pretty much being a negative company in terms of free cash flow. Ever since 2020, they've been consistently growing this black bar right here, which is your free cash flow, and growing operating margins, guys. Extremely strong, right? Operating margins is revenue minus cost of goods sold, direct expenses in relation to how they produce revenue. Their profitability has been going up ever since they really started increasing that in 2016, 2017, and made free cash flow and profit a primary focus of the business. So Netflix looking strong. Let's continue. Our updated revenue forecast reflects solid membership growth, trends, and business momentum, partially offset by the strengthening of the US dollar. Now, Netflix guided to third quarter EPS of 510 ahead of the consensus calls for 474. So yes, they gave smaller guidance on Q3 revenue, but their Q3 EPS, their profitability is going to be better than the expectation. So mixed signal right there. Now, here is a main proponent, guys. Subscriber additions of 8.05 million beat expectations of 4.7 million. They crushed it. Same thing as last quarter. Last quarter, we were expecting about 4.8 million, 4.7 million subscribers and net new additions, and they came out with 9.3. Once again, guys, tremendous beat on the amount of subscribers, which was one of the concerns for Netflix leading into this quarter right now. Now, let's move further. The company also told advertisers at its May upfront presentation that its ad tier had reached 40 million global monthly active users, a significant jump from the 15 million users the company revealed back in November, and a 35 million user increase compared to the year ago period. The advertising tier is now Netflix's bread and butter, guys. Extremely valuable tier for the company. Not only are they generating ad revenue from advertisers, something that the company did not do prior to last year, but it's doing a tremendous positive impact on them being able to continuously increase their subscriber count by offering a cheaper tier with ads, similar to kind of cable TV, right? In the earnings release Thursday, the company said it's making steady progress scaling its ad business, with ad tier memberships growing 34% quarter over quarter, highlight of the company so far. In another bid to boost the ad tier, the company said it will phase out its basic plan membership in the US and France after removing that sign-up option in the UK and Canada last year. So I'll explain here, guys. I am on the Netflix page for Canada. As you see, the standard tier membership right now with ads is only about $6 per month. Very cheap. If you want the premium version without ads, as you can see here in Canada, it used to be about $10, $11. There is no more $10, $11 regular category right now. They call it standard, but in all reality, it's premium because in the standard, you have unlimited ad-free movies, right? So the ad-free starts at standard, and then premium is of course, if you want more devices, at a given time, right? More connected devices. So you can see the big discrepancy here in the pricing, right? So if you do a little bit of quick math, it's very, very smart what the company's been doing, right? So the traditional normal subscription tier was about $10, $11 per month. In the US, it's about $10 right now, right? So what have they done to increase membership? They've increased a lot of members with this one right here. And now everybody who wants premium has to go up here, right? So, but the average between those two prices, right? $16.49 and $5 divided by 2 is literally the same price as the prior standard membership, right? So they're doing a great job at relatively keeping pricing the same for their subscribers, but they're funneling so many people into their advertising business or their advertising tier right there, which is generating them a lot of money from advertisers as a whole here, guys. Now, given this sustained progress, we believe that we're on track to achieve critical ad subscriber scale for advertisers in our ad countries in 2025, creating a strong base from which we can further increase our ad membership in 2026 and beyond. So they're really going all out on that ad tier, guys. Now, taking a look at Netflix's numbers, guys, Netflix's numbers were absolutely amazing. Take a look at this operating margin expansion. You can see how good the operating margin has become, right? I was showing you this graph before. Well, look at the last 5 quarters. Very, very consistent. Sorry, that was TSMC. Very, very consistent operating margin levels. And this one was one of the better ones that we've seen so far. Net income right now, about 22%, which is very, very strong net income for the company here, guys. Look at your global membership ramps, 277 million members right now, year-over-year growth of 16.5%, extremely strong, and generating a decent amount of free cash flow too, right? So Netflix has never been a company prior to just a few years back that was generating any substantial free cash flow. But all of that has substantially shifted now. You can see 2022, 2023, and especially the last few quarters, they are now consistently generating free cash flow. And why does free cash flow matter with bottom line net margins, guys? Because they can start doing a little bit of this. This is Netflix shares outstanding, right? 2010 till now. You can see finally starting to reduce a little bit of that share count, starting to do some of those juicy share buybacks. So Netflix operating on full cylinders right now. Nothing bad to say about the company at all. Everybody was nervous about a subscriber slowdown, but so far, no signs of that. And Netflix is doing a great job of mitigating that potential subscriber growth slowdown by offering that lower tier subscription model with advertising, right? It's doing very, very well for them. Now, in terms of valuation here, guys, well, revenue and growth revenue expansion and EPS growth expansion, very, very healthy through 2027, 10% revenue, 23% EPS, extremely strong, which gives them a PE ratio at 643, their current share price right now of about 35. Not too bad. But when we divide this by their EPS growth rate, we get a PEG of 1.52. Very solid PEG ratio for a very solid company that's growing excessively well, guys. Netflix, in other words, is not that expensive, guys. Even right here, guys, I really do think that it's a decent opportunity to be picking up some Netflix. However, there is a larger support zone below us, right? Think pretty much all the way between 635 all the way down to 600. So if the rotation out of big tech continues and Netflix unfortunately gets caught in that mix, we may just have an opportunity to be able to buy this stock in a juicier location, guys. That location is extremely strong. Just really expecting maybe a little bit of monthly pullback into that zone before potentially attacking the new all-time highs. So this little location right there, let me zoom in on it on the weekly, and you'll see what I'm talking about, guys. Gorgeous weekly uptrend, just looking to maybe consolidate back into this range, use it as support, and then eventually break out higher in the remainder of the year. Extremely strong for the company, good guidance, good quarter, no red flags whatsoever. So that's pretty much everything for our earnings recap, guys. Hopefully you enjoyed that. Now let's jump right into our technical analysis portion of the video, shall we? So moving into the SPY, continued consolidation on the SPY. One notable thing, guys, is inevitably the loss of the 12 EMA that we have pretty much virtually maintained since we got that last drawdown in the month of April. So now, the daily bears are in control. We have now officially lost the daily uptrend by flushing these lows right here. So the bears are in short-term control. Now, what we could be expecting is maybe a scenario where we get a lower high and lower low continuation of the downtrend. That being said, we are approaching a first line of defense for the bulls right here, and that is going to be 548 down to about 543. May just be a first line of defense, maybe then lower high, and then maybe the bears get another second attempt at it. That being said, we are in weekly consolidation mode as we lost the daily uptrend, right? So weekly consolidation mode underway. As I was saying, first line of defense lines up with the 12 EMA as well, but the bulls have so much space, guys. Beautiful weekly uptrend right now. Anything above 519, just looking for that weekly higher low for further trend continuation. Keep an eye on the retracement we had in April. That was about 5.5%. So top to bottom, if we do come down to that location right here, 5.5% would put us at about 534. Not that big of a deal in my opinion, right? So maybe continued downside is on the horizon, but as of now, the bulls still no major red flags for the continuation of this long-term bull market. Moving on to QQQ right now, same concept, right? However, QQQ did set the daily downtrend. So daily downtrend is underway right now. QQQ dealing with oversold conditions on the 1 hour and oversold conditions on the 4 hour as well. However, the bears are in short-term control of those timeframes. What we need to see by the bulls is kind of what we saw in the end of the day. Need to see them recapture the hourly trend. As you can see, I would have to turn after hours trading off, but in regular market hours, guys, we need to see the establishment of an hourly uptrend. Only then will we know that the daily bounce is underway. If you want the bulls to be able to recapture this, well, we need to see a heck of a bounce, guys. The bounce size, let's say we bounce from here tomorrow, we need to get at least as high as about 487 all the way about 490. If we can get into this pocket, it does give the bulls a good chance at resetting this into a daily uptrend and putting an end to this consolidation. If, however, the bounce is weak and we roll over continuously, guys, just know that we're just in for a little bit more weekly consolidation. Weekly higher lows are right here. 442, anything above 442, just looking for that weekly higher low for further bull appreciation later on in the year. And this area could be the last line of defense, 463 down to about 445. This beautiful location, prior all-time high resistance, should be newfound support for the bulls. So that is the likely area that I'm looking for them to act as a bit more support. If ever we do fall back down there, keep in mind the consolidation from last April was about 7%, and top to bottom on the QQQs would literally put us right in that little pocket as well, right? And even the one top to bottom last fall, that was a bit larger one, 10%. 10% would bring us down to the bottom end of this range as well. Now, moving into XLF financials. Financials pulling back after a beautiful week of rally, guys. So, they have to take a little bit of a breather. As we were saying yesterday, daily overbought conditions could lead to a little bit of a pullback. And we got it, right? I was saying, look at the hourly uptrend. If we lose the hourly uptrend and the 12 EMA, this yellow line right here in a significant fashion, that will be daily downtrend consolidation. So now, if they do set up the hourly downtrend, we'll be getting a little bit of daily pullback consolidation. All healthy though, the bulls in full control. Daily uptrend is nice. Looking for a higher low, anything above 4140, this level down there. Looking for that higher low for potential continuation of the uptrend. Keep a very close eye on your prior all-time highs, which is this yellow line. 4240, guys, could be a nice breakout, retest of this, and maybe run. And even if we slowly trickle down into it, setting a daily downtrend, well, you guys know so much space on the weekly. On the weekly, also looking for that weekly higher low for further trend continuation. So financials looking extremely strong, guys. Just a little bit of a healthy pullback, in my humble opinion. Moving on to healthcare, exact same thing on healthcare. Healthcare was really brought down hard by Eli Lilly, dropping about 7%. They're a big weight in the index. And even UNH starting to pull back a little bit on its gains towards the end of the day after such a significant rally past its all-time highs. So healthcare having a little bit of a pullback, but they had such a substantial rally over the last 2 weeks. I am definitely not surprised. Now we are coming down into a very hotly contested area, right? Talking about this area right here, 147. So prior resistance should be newfound support right now. We came into it very hard because of one company's decline, but still the bulls have a lot of space. Anything above 142.72, looking for that higher low for potential trend continuation, right? So this entire range really right here is just one big massive area of support. I would not be surprised if the bulls put a stop to this right here and then maybe start challenging these all-time highs. If they can't get it done in one full V-shaped recovery, then maybe they just have to make the two-step recovery process. On the weekly, things are looking very strong as well. Gorgeous weekly uptrend now in motion, and any more severe pullback, just looking for a weekly higher low, anything above 142.76, same level, just looking for that weekly higher low for further trend control. So that's why I say this whole area of congestion, guys, I mean, we're in it right now, right? We broke above the all-time highs, but any back test of this level should be met with some further price increases later on in the year. Healthcare usually responds very well to decreases in interest rates. Now, moving on to SMH, give me a very brief second. And let's get into it. So semiconductors coming a little bit back here after NVIDIA and Broadcom, two of the largest weights in the sector, had a very decent day of performance. So SMH not looking too bad at all. Take a look here. Daily downtrend is underway on SMH. So if this is the start of the daily bounce, hourly trend recovery, if it's the start of the daily bounce, guys, we need to see a very juicy bounce for the bulls to be able to recapture this daily uptrend, right? To put an end to this consolidation. So the bulls are on the watch here, guys. Need to bounce at least to about 268. If we can get up to 268, which is a 618 fib retracement, then it gives them a very good chance of resetting the daily uptrend higher. However, if the bounce is weak and we maybe top out at this resistance level right above us right now, 264, 265, could end up with a daily downtrend continuation, and that would just lead us into furtherance of maybe some more weekly consolidation as well, the extent of which maybe might stop here at 240, anywhere between 240 and 225, this area that I've labeled, just a likely area for some monthly consolidation before further increases in our trend. I don't think that semiconductors are going anywhere. As a matter of fact, NVIDIA, TSMC, and even ASML have told us as of today and yesterday that the end of 2024 and all of 2025 should be a very booming time for them. So just as of now, short-term consolidation, yes, not oversold on the daily yet, but we are starting to get a little bit oversold on our short-term timeframes. The 4-hour was oversold, and the 1 hour into yesterday's close was deeply oversold, but still no daily, right? So could just be a case in point where we get some extended consolidation down here. And if we do come down here, guys, that is the more the better area in my opinion, to have a buy the dip opportunity. Now moving into the Russell. Russell, important consolidation now for 2 days in a row. Very normal, guys. We hit pretty much 80 on the RSI on the daily. We were pointing that out and saying after such substantial 4 or 5 days worth of rally, would not be surprised that a pullback is coming just because we got rejected, guys, off of our massive resistance level, which was pretty much the 225 to 230, getting rejected from there now. So daily consolidation is underway, guys. Keep an eye on your hourly downtrend. That should be your guide. So as soon as the bulls get an hourly trend recovery, that is when you know the consolidation is over. So that being said, guys, daily consolidation is underway. Anything above 200, just looking for a higher low for further trend continuation. Now, if the Russell, well, the Russell may not be able to do this and V-shape right away, right? So if in the event we get a slower daily downtrend here, a little bit more of an extended pullback, a little bit more of an extended weekly pullback as well, just know, guys, this pocket right here is looking extremely good. 211 down to 207. Weekly uptrend, looking for the retest of prior resistance as support, and maybe then looking for the breakout. This area right here is the one where I'm more favorable to playing the Russell. And once again, that's pretty much 210 down to about 207. So if we see it, that is where I will be buying the Russell. As of now, just some very healthy consolidation. And now lastly, the Dow Jones. Dow Jones had a very good day, or a very good week rather, and now same thing as the Russell, pulling back. A lot of value names pulling back today after having rallied tremendously over the past 5-6 days of trading, right? So normal to expect a little bit of a pullback. Daily uptrend fully in control by the bulls right now, and daily consolidation is underway. Keep an eye on the hourly downtrend. As soon as you see this start to reverse, that's when you know that the daily consolidation is done and that the bulls are maybe looking for a second attempt at new all-time highs. That being said, if ever it doesn't manifest soon and we continue this consolidation into next week, just keep an eye out here, guys. Prior all-time highs, right? So 39,500 up to about 40K. That's going to be the breakout retest zone. You see it best on the weekly. Beautiful weekly uptrend right here. If we retest this area, just going to be looking for a higher low on the weekly for further trend continuation. So I love these breakout and retests of the prior all-time highs. Such a high probability trade. That's what I would be looking out for on the Dow Jones. Now, moving into our big tech names, shall we? So looking into Apple right now, Apple down about 2.05%, still in consolidation mode. And so unfortunately right now, Apple has lost the daily uptrend. Daily higher low is right here, 226. And unfortunately, we have now closed below it. So no daily downtrend yet. That would be lower high into lower low, but still daily consolidation is underway. Loss of the hourly trend, loss of your major moving averages of that hourly trend. So consolidation mode on the table for Apple right now. Now, need to be mindful, guys, that if we do get a bounce looking for a lower high into maybe lower low scenario, and the next area of support is sitting right down here at about 217. Prior resistance should be newfound support, and the 26 EMA is also sitting there too. However, if Apple just continues to have a little bit more of a downfall here into its earnings Thursday, the 1st of August, if somehow we pull back even more than that, just know that we're just in for a little bit of weekly consolidation. Gorgeous weekly uptrend, looking for the weekly higher low, anything above 207, just looking for that weekly higher low for potentially some further trend continuation, but Apple not being spared, just really consolidating with the rest of our big tech names right now. I see no red flags for the long-term, price appreciation curve of Apple, right? But just a little bit of healthy consolidation in the markets. Moving on to AMD right now. AMD, all being bought up and now all sold right back down as if this move never even happened. So very unfortunate for us, but at least we're kind of back into our range of support that we've been used to ever since the month of May, right? No stranger to the 155, 150 range, are we? So at this point in time, guys, well, the support lines pretty much stay the exact same, bouncing off the 200-day moving average right now. 155 down to about pretty much 150 is your more local area of support. The lower one, of course, is 140 down to 133. But so far, the bulls do appear as if they want to hold this one right now. So we will give them the benefit of the doubt, especially after nice TSMC earnings today. Well, the fall off on AMD wasn't too bad. Now, keep in mind, guys, we are 4-hour oversold conditions. Might be expecting a little bit of a bounce. Just keep an eye, though, guys, on the 1-hour trend. We need to get that 1-hour trend recapture to get a daily bounce underway. And now the fact that the bears have taken back all of the move, guys, we need to start it pretty much from scratch. They will need to reset the daily uptrend, and obviously the area above us is now going to be resistance, and that is 174 down to about 169. So I will continue to play AMD, guys, in the lower 150s at this point. No problem at all. Still believe in the company. They have 2 things to be released this month. Number 1 is going to be their earnings at the end of the month, of course. Number 2, the AMD series of new CPUs, aka called the Ryzen 9000 series of chips, which are slated to be as fast as Intel's chips, but use twice less power. So they're pretty much 50% more efficient in that regard, right? So extremely bullish news catalyst potentially on the horizon for AMD. And do not forget, 2025 is their massive EPS and revenue expansion phase from all the data center applications that they've been building out for the past 6 to 9 months, right? So 2025 should be a much better year for AMD, but as of now, price is holding decent. Fundamentals are very good as well. So I like this opportunity down here to throw in a little bit more in terms of buying more shares. Moving on to Amazon right now. Amazon has really not had a very nice trading day or very nice time since last Thursday at all, right? Company is down pretty much almost 9%, right? And anytime Amazon has had roughly 8-9% dip in recent memory stemming from pretty much April, right? Usually been a good opportunity to buy. Even this one back down in September, which went all the way down to 17%. You guys see what happened after. So in the event that Amazon continues its pullback into our large area of support, 177 down to 165, that would be your 13 to 17% decline on Amazon. And I really hope that you guys are going to be sitting there with buy orders for this amazing company that is expanding free cash flow and profits and posting record numbers for those two metrics as well. So that being the case, guys, daily downtrend is well underway for Amazon. Still not in a case of daily oversold, but on the 4-hour, we are definitely getting 4-hour oversold. And even on the 1-hour, guys, we're teetering within the oversold conditions, right? So keep an eye, watch for the change in the hourly trend. When we get the change in the hourly trend, daily bounce is underway, but with such a deep cut, guys, probably just looking out for a lower high into lower low. The 190 area, which was such big resistance for the bulls for a long time, it was support, but we just blasted right through it. So now, unfortunately, it will be resistance and maybe just be looking for another leg down as our big tech continues to consolidate, right? If you want the bulls to get back in control, we're going to need a heck of a bounce from here, guys. The bounce needs to come at least as high as about 190 level. If we can get up at least to about 190, then it can be in the bulls camp to maybe set up for a daily trend change. But no, they do have earnings coming up next Thursday, right? So not a lot of price action before them. If ever Amazon dumps into their earnings, right, I would be very surprised if they do. But let's say they do and come all the way down here, guys. I'll be sitting there with buy orders 100%, right? Even in the low 180, 175s. I love this stock down there, and I will probably be playing their earnings. Weekly uptrend still healthily in control. A lot of space between us and our weekly higher lows at 175. So no immediate red flag concerns for the bulls just yet. Moving on to Google right now. Give me another quick second. Haven't taken a sip of coffee on Google for a while, but that was kind of the meme of my channel for a considerable amount of time. So moving on to Google now, guys. Daily downtrend is clear as day right now. Bears in full control, of course. No daily oversold conditions just yet. 4-hour, though, deeply oversold, and 1-hour conditions teetering with oversold as well. But same thing as the rest, guys. Watch for that hourly trend change during regular trading hours. Only then will you know that your bounce is underway. When we do get the bounce, guys, just know that we're probably looking out for a lower high, and then it'll be up to the bulls to determine whether or not they can set into a new daily uptrend or whether or not we flush and continue this daily downtrend. That being said, reacting nicely to the 50-day EMA that we're on right now, and this area of support, prior resistance, kind of like Amazon, at around the 180 level, closing slightly below it today. So in the event we continue in Google's decline, guys, Google has earnings next Tuesday, so only 3 trading sessions left for Google. Going to be very tough to determine price action. Usually the expected move on Google is anywhere between 6 to 7%, so 6 to 7% could really put us back to the all-time highs or back into a very juicy buying opportunity zone, which is going to be the 165 level, pretty much the gap area after last earnings. So either way, I'm very interested in playing Google stock. Weekly uptrend is very, very healthy right now. Just looking for a weekly higher low, anything above 171, just looking for that higher low for further trend. So in the event that Google earnings are softer than expected and come down, I will be a buyer of Google. Anything below 170, guys, 170 down to 160 is free money, in my opinion. From the all-time highs, that would pretty much be a decline on Google, anywhere between 11 to 15%, and we need to buy those, guys. It's always been a great buy the dip opportunity in recent history whenever Google goes on these 10, 13% declines, as you can see all throughout 2023 as well, right? So looking very, very strong on Google, even though the bears are in short-term control, your longer-term bulls are in even better control. Moving on to Meta right now. So Meta putting a stop to its decline today, actually green 3% on the day. Nice to see them recover a little bit. My buy the dip at the end of the day yesterday was definitely rewarded. So now, see, this is what I mean when I say hourly trend recapture. So now we have a little bit of a daily bounce underway. We will see, because we are in a daily downtrend right now. Size of the bounce is underway. Need to keep a close eye on the size of that bounce. So far, so good, 38% bounce, but we need to get at least as high as the 618 retracement. That's going to be 488. If the bulls can bounce up to 488 in this one move, they have a good chance at resetting this into a new daily uptrend. That being said, Meta does not have earnings very soon. They have earnings pretty much in 2 weeks' time, Wednesday, the 31st of July. So they do have an opportunity next week if the rest of big tech earnings are good, Google and Amazon pretty much, if ever Meta responds positively to those, then you might be able to see a nice uptrend recapture. Reacting nicely from this zone though, guys. A lot of momentum into yesterday's session, but today definitely using this area of support as support and getting a little bit of a bounce underway. Once again, that's 482 all the way down to 456. And I continue to reiterate, guys, if Meta continues to plunge lower than 450, I am buying the heck out of this stock, guys. 450 all the way down to the low of last earnings. 420 is free money on Meta, in my humble opinion, not financial advice, but it's free money for me, right? If none of you guys want to take it, I'll just take all the gains myself, and Meta should be able to have some decent gains. Record profits, guys. Very nice EPS and revenue expansion. No bad things to say about the company. Yes, we have lost the short-term weekly uptrend, but reacting nicely from this zone. Same thing happened here after their earnings, right? We lost the weekly, and then it took us a while to get it back, but that is just some things that Meta does sometimes, right? May take them a while to get back, but they definitely will get it back, in my humble opinion. As of now, looking good though. This lower location is looking like a decent range to start DCAing and buying the dip on Meta. Moving on to Microsoft right now. Microsoft also declining a little bit more, but retracing towards the end of the day. So Microsoft, similar to the rest of its peers, daily downtrend is underway. Daily, not close to being oversold yet. 4 hour, definitely a little bit oversold. At even the 1 hour, we're teetering between oversold and not. So we're going to be watching nice bounce on the hourly right now. We'll be watching for the hourly trend conversion to the bulls, and our daily bounce will be underway. Then we need to watch how big of a bounce, guys, do we get from the low to the high. If we can bounce at least as high as about 447, which is not that far away as of now, 447 sets the bulls up for a chance at resetting this into a daily uptrend. Anything weaker than that, and unfortunately the bears will have another attempt at bringing us back down here. I like this area right here. We got into my desired area right here, guys. 435 down to 440, or 430, excuse me, right? Prior all-time high resistance, this yellow line, should be newfound support. And Microsoft now from the all-time highs is down roughly about 6%. At the low of the day, it was down about 7%. And usually in most recent history, guys, those have all been buying opportunities, right? Here it was down about anywhere between 7 and 9% after their earnings. This little dip right here at the end of May, that was another 6% dip. Right, we have to be buying these dips. Even this one back here, that was a more 12% dip. But if we were to take it from the average of the highs, right, only about 8, 9% to the downside. So whenever Microsoft presents us with 7, 8, 9, 10% dips from the all-time highs, usually a good buying opportunity, especially when the weekly bulls are in full control, looking for the breakout of the all-time highs, retest of the all-time highs as support, and maybe run further down the line closer to their earnings, right? Tuesday, the 31st of July. So looking pretty good. If Microsoft continues its slight decline into here, I will be looking to build a little bit of position even before earnings. Moving on to Netflix right now. So Netflix obviously just had their earnings and are pretty much flat in the after hours. So we will see, can the bulls defend this area down below us, right? 635 down to about 607 is going to be the huge area of support below us. Pretty sure that the bulls are going to be able to defend that quite well. Now, what they have to do to recapture this, daily downtrend is underway right now, need to give me a break above 663. If we can break above 663, it's fairly close. Could be an opportunity to reset into a nice daily uptrend and just continue this gorgeous weekly uptrend to the upside as well. Hopefully the timidness around earnings is now erased, and hopefully the bulls can just resume their trajectory beyond the all-time highs, which are all the way back here about $700, right? So looking fairly good on Netflix. No red flags whatsoever. One thing's for sure though, if we dip further, 635 down to 607, that is where I will be adding a little bit of shares on Netflix. Even wouldn't be opposed to adding a tiny little bit of shares here, but I'll go a little bit heavier if we do dip down into those locations right there, because that would be a dip from the recent highs of anywhere between 8, 9 to about 12%. And usually in recent history in bull markets, that's been a very nice buy the dip opportunity. Think of all the times back here, right? 6 to 10% ever since they've been in a net uptrend once again has been a good buying opportunity since the long-term bulls are in full control of this chart. Now, moving on to NVIDIA. So NVIDIA also up today, 2.63%, looking pretty good. However, in a little bit of a daily downtrend right now is NVIDIA. So the bounce is starting to be underway. Obviously, guys, we're not really close to being daily oversold. We weren't 4-hour oversold for that long either. Trying to reset this into a 4-hour uptrend. Hourly uptrend is also back, recaptured by the bulls in the end of the day. Looking very nice. So suffice to say, a daily bounce is coming for the bulls. Need to get as close as possible to 131.22. Keep an eye on the size of the bounce, guys. If they put in over, let's say we bounce over 126 in this same move, it gives the bulls the best chance at either the complete V-shape or the 2-step daily uptrend recovery, reacting very nicely from this zone of support that we label out on the chart, guys. 119 down to 115, perfectly bouncing off the 50 EMA on the daily as well. So we'll be on the watch for that daily uptrend recapture by the bulls. In the event this just continues to fall apart and we break down lower, that will be weekly downtrend continuation for the bears right there, and maybe looking for a little bit more monthly consolidation, maybe bringing us back down into the $110, $100 level, which could be a very juicy opportunity for buying NVIDIA if ever we come back down into there, because the valuation at 100, 110 down to about 100 is a lot more manageable for this company. Moving on to Tesla right now. Tesla, just straight consolidation day, right? Very nice tightening range by Tesla at the top. So beautiful daily uptrend into sideways range-bound consolidation. Probably going to last into earnings, guys. Earnings pretty much coming out next Tuesday. So only 3 trading sessions left. In my opinion, this will stay range-bound until earnings, guys. Tesla expected move usually about 9%, 10% sometimes, right? So it can really take us one of two ways. Either we're going directly, guys, into the next area of resistance at 285, 10% move to the upside would be almost that, right? 275, 280, and 10% move to the downside would put us at the lower end of this range of support that I've labeled on the chart. And that's going to be pretty much this green box, 240 down to about 225. This is the area that I will be looking to play Tesla in more aggressively myself, just because it's a nice area of confluence. Downtrending trend line is right there. 26 EMA is right there as well. The other moving averages are curling up slowly into that location. They won't get there before Tesla probably has another rally, but this is just a location that I'm more keen on playing Tesla in. So we'll keep a close eye what happens before, rather after earnings. But until earnings, guys, I really think we just continue to tighten up, because a lot of expectations baked into this one. And I think a lot of people are just waiting to see whether or not Tesla's recovery story is finally here or not. And now lastly, Palantir. So Palantir not looking too bad today, up 1.49%, but they were actually up close to 5% on the day before they really gave it all back during the midway session. Now, no red flags on this chart at all, guys, right? It looks a little bit messy, but this is a very, very nice daily uptrend on Palantir right now. A little bit messy, but it is a daily uptrend. Daily higher lows are right here, pretty much 27.51. So nice continuation here. And now above our $28 level, the $28 to $29 level, guys, is very important. 28 to 29, right? Huge area of prior resistance, 2020 and 2021, now acting as resistance as well. So in the event that the bulls cannot complete this breakout in a considerable fashion, well, we may just be plunged into a little bit of daily consolidation. If that daily consolidation happens, just know that we're just looking for the weekly higher low for further trend continuation, right? And that is going to be 26 down to 25. This is the next area that I'm willing to play Palantir. Looking very, very good there. And the monthly bulls, guys, nothing bad to say about them. Full monthly uptrend expansion right now, which is why I say a dip down here, 26 to 25, could be a very nice potential gift for Palantir. That's pretty much everything for our daily market recap, guys. Now, in terms of a few swing trades that I'm going to be looking for in the next few days of trading. So, number one, keeping on that theme of rotation into more value-oriented names, and maybe into names that could be interesting in the event of a Trump presidency, right? Well, number one is going to be a company that all of you should know, one of Warren Buffett's largest holdings. That is Occidental Petroleum. Occidental Petroleum, obviously an oil company, energy, right? That should be very, very good for in the event of rate cuts, and also in the event of a potential Trump presidency, right? It doesn't mean that Trump is going to win, guys. We're playing the narrative right now, right? It doesn't matter if he wins or not. If everybody thinks that he's going to win, then these are the narratives that will probably do very, very well during the whole run up to the election, right? So moving into Occidental Petroleum, as you can see, very nice consolidation range pretty much from the last 2 years of trading. And now might just be looking for a little bit of a breakout here, guys. So getting really, really, really tight, kind of exactly like what, well, not for the same amount of time, but kind of exactly like what Berkshire was doing for pretty much since February, right? But Occidental Pete has been doing it for a lot longer time and building a very nice shelf of support. Take a look at the analyst targets on this one, guys. Analyst targets are all largely above the stock, and the stock has very decent fundamentals as well, right? So I am looking for a little bit of a breakout. Weekly uptrend is now recaptured by the bulls above all of our moving averages as well, and maybe just looking for finally that monthly breakout, right? Looking very, very nice for a monthly breakout, targeting maybe the higher midpoint of the 70s, right? 73, 74, 75. I'm not targeting the all-time highs, guys. We're just looking for a little bit of a swing trade, maybe up here in the $70 range. And we have very nice support down here in the lower $56, $57 range, right? So Occidental Petroleum could be a nice runner, guys, and that ties into the larger XLE, right? XLE Energy looking very, very good, guys. guys, this is pretty much a very gorgeous bull flag looking for some potential appreciation on the energy sector as a whole, and I do not think Occidental Petroleum will be left behind some of its sector peers that have already run. You can see Chevron doing pretty much the same type of consolidation, and the other big one pretty much is ExxonMobil. ExxonMobil looking like it wants to break out as well, so Occidental Pete could be providing a decent opportunity too. Now, another trade that I'm going to be looking for, industrial play, right? Once again, because interest rates are coming down and the event of a Trump presidency, right? Make America great again. And what is better than, farming, industrial machinery, stuff like that? John Deere usually does excessively well in that type of environment, in that type of narrative. That being said, the PE ratio for the company is one of its lowest it's been in the past 15 years. Looking like a very nice opportunity here, guys. The fundamentals of the business have been doing great since 2021, and we've just been stuck in a wide range of accumulation this entire time with a gorgeous shelf of support below us here at about 360. So I like John Deere from here, guys, and you can see what's happened since last Thursday's CPI. Nice reversal, daily downtrend, engulfing move, looking for the daily higher low, potential trend continuation, right? So if we retest this range right here, 375, 370, looking very good for a potential entry and run for John Deere, looking very strong, trying to recapture that weekly trend as well. So this might be the start of a couple of months worth of rally for John Deere, probably targeting the all-time highs and beyond, right? So this could be a very good one, guys. Once again, industrial equipment, these things require a lot of financing, and with interest rates coming down, this one may get a lot of attention, not only from a potential Trump presidency, but also from the rate cuts, right? So very, very on topic trade, in my humble opinion. The third one is not so much a trade in relation to rate cuts or anything. It's just one of a something that's not big tech, right? Intuit, I love this setup right now, guys. Weekly cup and handle setup. It's pulling back perfectly into our moving averages, and we have a nice area of support below us, 620 all the way down to 602. I love this setup, looking for the weekly higher low for the potential breakout here, guys. It's looking so good on a technical basis. Gorgeous monthly uptrend, maybe just looking for some continuation. So Intuit has been one that I've been playing a lot, right? Played it after earnings back here, played it here on this dip, sold it out here, and now it's giving us more entries, right? So I will be looking this time, however, I will be looking to take the continuation from this larger pattern trade into maybe new all-time highs, probably targeting, closer to that $700 range, looking excessively strong as just a technical setup for a very, very strong company that's been underperforming the SPY, guys. They are only up. They usually outperform the SPY, so there could be a little bit of a mean reversion trade, only up 2.5% year to date. So I do think that they have a good opportunity at catching up. Now, the other trade I'm looking at, guys, is Mercado Libre. So Mercado Libre, you guys know I've been swing trading it a bunch back here, guys, and selling it into the 1700. It's only a matter of time. The next position that I do get, guys, we're getting in before earnings, and I think they're going to absolutely crush it like they did last time. So anything from here all the way down to pretty much in the 1500s is a great buy location for myself or anybody looking to swing trade this one, looking once again for that weekly trend breakout and also looking for the continuation of the monthly trend breakout as well. Looking extremely strong. Company's fundamentals are amazing. Great management team. If you don't know this one, only trading at a 1 peg. Look at these expansion levels. And if you think it's just for 1 year, guys, you're deeply mistaken. Company is now net profitable, expanding revenue amazingly, expanding EPS amazing. Look at this EPS curve, nasty. Look at this revenue curve, gorgeous, right? Very, very nice company. And this might just be one of the last times that we get to get it at a 1 peg before it really starts blasting off towards the all-time highs. All of your analyst targets, guys, are significantly higher than the stock price right now. Now, moving on, guys, I got a few real estate thematic plays for you guys. These are just basically entirely predicated on the interest rates coming down. So, number one is going to be Realty. Heck of a rally since that CPI release, right? So we're going to be watching for the pullback. Usually REITs don't get overbought for that significant amount of time. So in the event of a pullback here, guys, think maybe $56 all the way down to $55, this location right here, in line with our prior resistance. That's maybe going to be the breakout, retest, trade, and run. So I'm very interested in Look, it's still down significantly from anywhere close to its relative highs in the high 60s and 70s. Gorgeous weekly trend expansion here, guys. And even on the monthly, watch out, looking to set up for the monthly trend change after being in a monthly downtrend for 2 years at this point, right? Finally starting to break out. Is one to watch. They are the largest player in terms of triple net leases. They own a bunch of triple net leases for companies like Walgreens, Wendy's. Think of all different triple net leases, right? Home Depot, stuff like that, right? They collect a ton of rents. Fundamentals are amazing right now. Take a look. Nice. Well, you can't really look at EPS, guys, because it's a REIT. I'll explain that in a different video, but we can't really take EPS because depreciation is heavily included in that. Now, in terms of revenue, though, revenue expansion is really, really, really strong for this company, even since the pandemic, right? So looking very good, undervalued in my humble opinion. Another REIT that's run a lot recently, guys, is Vici, but Vici still has tons of room to move, in my humble opinion as well, looking to reset into a new monthly uptrend. And this location where we were buying on the channel down here is great. But if we ever get a little bit of dip, guys, has ran a lot, overbought conditions right now. If we get a little bit of a back test down here, think a back test of 30, 29.50 down here could be a great location to add some shares for the continuous upswing on Vici. Vici, one of my favorite REITs in the entire game. And the one we just saw, the previous ticker, and this one, they both pay around 5.5% dividend yields. Tremendously strong in my humble opinion here, guys. Another last one up for consideration is Public Storage. Public Storage needs no introduction, right? Gorgeous weekly uptrend now forming and looking to break out of these highs, guys. Look, we've been trapped among these highs for a while of time. I think with the rate cuts finally coming now, if we do get a little bit of a pullback here, guys, they've ran also same thing, get a little bit of a pullback back here, maybe into the 295, this location right here. If we get a little pullback into the 295 zone, I'm thinking of loading up some shares or maybe some debit call spreads and looking to really play this expansion on this business. The business is doing very, very good, extremely high net margins. This company is such a beautiful one. I don't talk about it that often on the channel, but looking very good. EPS, you can look at EPS on this one. EPS expansion is very strong, and also revenue is extremely strong as well. They kind of fall, they're kind of a hybrid. They are technically a REIT, but they're not at the same time, right? A little bit of a hybrid model right there. Pays a decent dividend, 4%. No problems with the company. I really do believe, guys, that this might be the time that Public Storage is looking for that final monthly trend expansion after being stuck here because of high interest rates, right? Now, moving on, guys, a few financials names, and then we're pretty much done. So a few more names, guys. Visa and MasterCard have been talking about these for so long, but now you guys have seen the rally, engulfing move by the bulls. Any single move lower, looking for a daily higher low, anything above 259, daily higher low for further trend continuation, guys, and recapture potentially of the weekly uptrend, and just looking for continuation of the monthly uptrend, reacting beautifully from our support lines that we had drawn here at the lower or the mid 260 points. I still think that these are tremendous potential swing trade opportunities and long-term investments. MasterCard is the exact same chart. Take your pick, whichever one you want, guys. Their fundamentals are largely the same. It'd be very, very hard-pressed to nitpick between which is better, Visa or MasterCard. Any of the two, very, very nice. Same chart for MasterCard, same principle, just looking for that monthly higher low for further trend continuation. Very nice, past 3 months worth of dip, guys, right? We have to be buying these dips on extremely solid companies like those. One of the last few trades, consumer discretionary, but not totally, because this one is a luxury trade. Louis Vuitton, I bring it up every now and then, guys, but this is my favorite retail trade in the space. Forget Nike, forget Starbucks, forget all of that. This is one that continues expanding regardless of market conditions. They are not affected by a consumer slowdown. They're a luxury brand. Rich people do not lose money in a recession. Sure, do they lose clients here and there, those clients that can't afford Louis Vuitton bags but buy them anyways, and now that we might be in a little bit of a slowdown, they stop? Yes, but their core client segment is not affected. Take a look, EPS, unaffected whatsoever. Great growth over the next 4 years. Revenue as well, great growth over the next 4 years. Nothing bad to say, and it's in my juicy location, guys. You guys know every time we get back to 150, I love buying this stock, looking good. Monthly tightening range, just a matter of time before this one explodes and never really looks back. So long-term investment, short-term swing trade, I'm all for it. Look at your analyst price targets, 150 all the way up to about $200. Lots of meat left in this trade, in my humble opinion. And the last one is going to be McDonald's. Now, McDonald's has been down. Pure technical trade, guys. 50 monthly moving average, only tested during COVID, and then never since over the last 10 years, right? That's on the monthly. On the weekly, 200 weekly moving average as well, tested during COVID, and then not since again since 2015. So technical entries are great. That being said, McDonald's is obviously part of the consumer discretionary trade, and it's currently down from the all-time highs about 14%, but I still love this company, guys. McDonald's is such a solid business model that even when consumers are slowing down, guys, they change up their menus, they offer promotions, they offer discounts, and McDonald's is one of the larger players in the game. They can literally floor prices into the ground and really put pressure on their competition. So if there's one consumer discretionary stock in terms of food that I would like playing, This one and Chipotle are two very high picks for me. Domino's Pizza as well, really amongst those three, but McDonald's fires off all the technical signals for me, which is why I like playing it. Looking very good for some daily trend recovery here into their earnings next week. Maybe also some weekly trend recovery, expecting a nice little bounce. First stop 275, and then we're looking a little bit higher. A little bit of a swing trade, but even a long-term investment, guys. How can you go wrong with a company like this, especially when it offers you a nice discount? That's pretty much everything I had for you guys today. Sorry for making these videos a little bit longer, but you guys know how it is in earnings season. Especially when we have some corrections like this, right? I have to talk more about them. I'm pretty sure you guys wouldn't want me to just go through the SPY and say, yeah, so support on the SPY is here, resistance on the SPY is there, and now let's move into QQQ, right? I have to give a little bit more meat in terms of the explanations, which is why the videos are a little bit longer. And obviously we have to cover a few earnings names as well. So hopefully you appreciate the more in-depth analysis that I provide. I apologize for the length of the videos once again. It's a continued thing that I've been working on in the channel. When we don't have earnings season, I can get them down to, to 25, 30 minutes. But then when I do portfolio reviews, often during the week, often that takes 10, 12 minutes each time because I'm running more complex trades right now. 4, 5, 6 months ago, or even 2, 3 months ago, right? You guys know me. I would only have about 5, 6 positions, only short puts at any given time. But then obviously I'm opening up a few more trading strategies right now, just for those of you that have smaller accounts that are interested in swing trading with shares or longer duration call options or put credit spreads, call debit spreads, stuff like that, right? So that's why it takes me more time to go through everything right now. So I won't keep you guys any longer. Hope you guys appreciated the video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every single Monday to Friday after the close. And as usual, if you have any questions at all, guys, feel free to leave me a comment down below in the comment section. I'll be happy to answer you. So take care, guys. See you tomorrow after the close. Take care and peace.